Welcome back. I've been speaking with NC Badri Nivas, the head of markets and security services at Citi South Asia, on everything connected with the financial markets. We've just been discussing the bond markets, and Badri continues to believe that 6.1 to 6.4 on the 10-year is likely. Well, time permitting, I'll come back to bonds, Badri, but now on the currency. First up, can you tell us how are you interpreting the Fed's stance from an India investor point of view, from a India currency point of view as well?
So last week, FOMC obviously, came with a bit of an hawkish tilt in taking up the dot plots higher. I think from a 0.0 in March of no hikes for 22 and 23, now it's a 0.2 in terms of the Fed's dot plot. Our global view has been Fed to start tapering from December this year, and Fed to do a first rate hike in December 22. That's been our view from a global, macro strategy team, and that was pre-FOMC, and they have not changed that post. So in a sense, we believe that this is kind of the Fed's move is kind of expected, given how well the U.S. economy is bouncing and so on. I guess from a market point of view, the adjustments that you saw on the Fed, I wouldn't say it is a significant hawkish tilt. It is more the markets some part of the market was expecting Fed to be too complacent and too easy and not really bothering about any of the recent data. And to that extent, it's been a bit of a reassessment of the fact that Fed may not fall too much behind the curve. But I don't think it is anybody's interpretation that Fed is going to get ahead of the curve and do a taper and normalization too quickly, etc. In fact, Powell, I think talked about the fact that some of the inflation is still transitory. To put it differently, it's not like the Fed is talking about taper. The Fed is talking about taper, and that's a big difference, right? In terms of thing. And the experience from 2013 is obviously fresh for everybody. So our base case expectations that any normalizations by the Fed will factor in, the implications for the broader markets globally, and therefore will be done in a very non-disruptive way. Now that's the base case. Coming to India and what it does, obviously we have had a strong dollar view. Some of it has already played through, if you look at it, the way euros moved and so on. But we continue to feel that, dollar in general will have will be stronger in the coming months. From an India point, with regard to INR, I think a lot depends upon the RBI's intervention strategy. Because if you look at the data, even though we expect a CAD to be current account deficit to be about 1% of GDP for this financial year, overall we expect a large BOP surplus of $40 to $45 billion. So to that extent, INR shouldn't be any undue pressure from any global strengthening of the dollars. Our reserves are very strong. The RBI has more than sufficient ability to intervene, and we don't expect INR to be under any undue pressure from a depreciation point of view. But having said which, given how RBI has been intervening, our near-term expectation is for rupee to probably move towards the 75 levels. But that's simply because of some of the seasonal factors and how RBI has been, continuing to build reserves. But that's more I would say a measured move rather than any
jerky,
strong pressure on the currency. RBI has more than sufficient reserves to manage.
Oh, of course, they have plenty. But Badri, can you also give us a number on the dollar index? It's just on the cusp of 92. Do you see it? What's the range and direction?
Yeah, we think that it'll strengthen, and that's our view, and it'll go towards 93 half by the year end. That's really broadly the expectation, and that view has been there for some time. And if you look at it, euros moved from 122 to 117, so some of it is already played through. But in general, across EM, we have pared down our any bullish call on the EM currency, and we believe that there could be some minor depreciation of EM currencies vis-a-vis the dollar in the coming months.
Okay. Yeah, of course, if you're expecting the rupee to go to 75, then the dollar index perhaps would be closer to 93. Now, if that happens, if the index moves towards 93, 94, do you expect equity fund flows into India and therefore EMs as well to taper? It's not very good now. It's running negative.
Yeah, look, all of these are, at the end of the day, Lata, if you look at it in context, right, there has been extraordinary monetary support to the global economies. And some bit of pairing is obviously expected, and it's good. In fact, the equity markets would probably take, solace from the fact that if the Fed is going to do a soft landing, is much better than dealing with a hard landing from a normalization point of view. So our sense is that ultimately the accommodation still continues. I mean, the Fed is continuing to buy $120 billion of GSEC plus US Treasuries plus MBS securities every month. And our expectation of taper, like I said, is December. So, we expect them to talk about tapering from December and pare down their purchases by about 15 billion monthly. Okay. But if you look at between now and December, they're still going to buy 120 billion. And that's new money being created and put into the system and so on. So we don't expect any significant implication from some of these conversations around policy normalization on the near-term flows. There is still a significant amount of global liquidity looking for, a home from an investment point of view. And from India's, I think it's from an India valuation point, obviously, we do expect our overall 12-month forecast is around 15,500 or thereabouts, just pretty much around the current levels. And it's really because a lot of the corporate profits have expanded and there's been a significant amount of expectation of earnings growth built in. The question now to see is that as the economy opens up, whether the demand really bounces back to the same level, does it entrench? And also, one of the biggest benefits in the last 2 years from a corporate point of view is really the fact that they've been able to reduce their cost and the margins have expanded. So the question now is that, will that sustain, right? And those are some of the things that from a valuation point of view, the Indian markets have to deal with. But in general, from your question on flow of funds, we don't see any significant, headwind on that at the near term.
Okay, not a significant headwind. All right, Badri, you spoke about tapering, the Fed tapering only by December. There are some views on the street that they will start as early as September also. What about India? When do you expect the first variable rate repo to be announced?
I think the liquidity normalization is likely to happen in Q4. Obviously, a lot depends upon the incoming data, but I think there is, the festive season is important, Lata, this time, right? Both on two fronts. One is, of course, to see how much the demand remains and so on. But ultimately, from a monetary policy point of view, right? I mean, when this has been a question all through the last 7 years when we moved to the inflation targeting or inflation target regime, right? The question is that do you set your monetary policy interest rates to in what is the frame of reference that you do? Is it only for all kinds of inflation or only for demand-led inflation? Because at the end of the day, if there are supply side related or commodity related or the food price, I mean, if you have a not a good monsoon, etc. If you have some of these idiosyncratic factors influencing inflation, now what is the ability of monetary policy to actually go and influence the outcome? So you can hike rates, but you may not get the desired outcome, except to actually pull down some parts of the economy, which can actually help address some of the supply side constraints. So I think, it's important from a monetary policy to see whether we are getting either, if it's a runaway inflation, then obviously they have to react, even if it's whatever supply side led, whatever. Or if there is, because of the economic bounce back, if you see demand pressures coming in, asset price inflation on properties and stuff coming in, then, maybe they'll have to say that, well, we need to,
got that.
Faster.
But
all of that will really depend upon the incoming data.
But I have to interrupt you over there because, Ashima Goyal, the MPC member, told us that they will also be looking at credit growth. That will indicate a money multiplier. So we have some idea of what RBI is going to watch. But my final question, and we don't have much time for this, but it's an important one. You have been through the 2004-2008 period. In 2003, yesterday we had Rakesh Jhunjhunwala saying that it feels like 2003 in the sense corporate balance sheets have been cleaned up and, 2003 they were ready for a capex cycle. Both looking at global and internal factors, does it feel like 2003, 2004 and a great run ahead?
Look, Lata, I'll put it this way. I'm quite optimistic on the growth prospects. I think we are seeing some incipient signs on capacity expansion. Some of the steel companies have announced some big plans in the next few years. The government's infrastructure push has been significant in the last 2-3 years. You'll see some of those projects coming through. So on the overall things, obviously the virus is a big unknown thing. So keeping aside the virus risks, etc., I would think that I'm quite optimistic on the growth prospects in India in the next 2-3 years.
Okay, that's a great note on which to end this conversation. If only we could keep the virus risks out of our mind. That's a tough one. Thank you very much, Badri Nivas, for joining us on a range of issues that confront the Indian financial markets. That's it on this special edition of Indianomics. Thanks for watching.